Okay, I think we're going to go ahead and call the meeting to order. Robert and Nick both have obligations at 1 o'clock, and I don't think any of our county commissioners are going to be here today. So we've had a chance to review the agenda. Do we have a motion to approve the agenda?
So moved.
Right. Second.
Second.
All those in favor of approval?
Aye.
Great. I think I'll provide you with just a couple of updates here. Our IAC membership is obviously stabilized thanks to a couple of renewals and some new additions from last year. So we're in good shape there and very much appreciate everybody's active participation in this committee. Also, I did invite Elizabeth Happe, who's our internal auditor, to this meeting, and she was not able to attend because of the scheduling conflict as well. So typically she would like to be here, but she won't be able to attend. Angie, any online attendance?
Yeah.
Okay, so I don't think we'll actually need to go around the room with introductions. I think we all know each other quite well. We did send out copies of the meeting minutes from our April 2nd meeting, 2024 meeting. Do I have a motion to approve these minutes?
I make a motion to approve.
Second. Okay. You guys will be in the minutes for next year. We have a second. Any discussion? All those in favor of approval?
Aye.
Motion passed. Now I'll provide a brief review of our most recent treasurer's report, and this would be the one dated August 31st, 2024. Our portfolio balance was almost 282 million at month end, which is a decrease of 4.8 million from July, but an increase of 25.6 million year over year. Several factors to consider in this increase was due to the issuance of a $20 million bond last fall to help fund the new courthouse expansion. That was actually a $50 million bond and $5 million in DOJ funding. And additionally, in February, we received that $5 million in funding from the Oregon Department of Justice. And this is to fund the ongoing courthouse construction project, which is a $40 million construction project. And with that servicing, it's about a $60 million total project. And that's slated to be completed late 2025 or early 2026. Also, we'll note that these funds have been invested to ensure maturities that match the expected disbursement of the construction contract with Pence Construction. And you'll note our 5-year maturity distribution schedule that I just handed out. We actually are breaking that out now on a monthly basis to show how much of our current redemptions are actually targeted towards courthouse funding. So that was a question and a comment that came out of our spring IAC meetings. And so we're now doing that. Net investment earnings were $810,000 for the month, which was slightly lower than the prior month, but $318,000 higher than a year ago. And again, this is reflective of the higher rate environment that we're currently in and also growth in the portfolio year over year. All portfolio category balances are well within policy guidelines. And I will comment, and we'll talk a little bit about the rate scenario a little bit later, but we were notified that the local government investment pool, which is Oregon State Treasurer's Office, they lowered their rate to 5.15% in early October, which was down from a high of 5.3%. We've been expecting that reduction in rate over several months, and frankly, lasted a little bit longer than anticipated. But anyway, we've been able to take full advantage of that higher kind of pool rate. The average portfolio yield was 3.6%, which was an increase from 3.4% the prior month. And the portfolio now has a weighted average time to maturity of 0.81 years versus 1.1 year at year end. And this is a function of we're basically keeping greater balances in short-term funding, which we're able to take advantage of both the rate that First Interstate Bank, our investment bank, is offering, as well as the LGIP funding rate. And we're roughly targeting 40 to 45 million in that short-term investment pool. And also, I will state that the duration is actually skewed by the courthouse-related funding, which is invested to match the expected disbursements on the construction project. So we're keeping a larger portion of funding short-term to match the expected duration of that construction project. Yeah, I will also note that the LGIP limit has now been increased to 61,749,000, which will be beneficial as we head into our busy tax collection season. So we'll be able to take advantage of that higher limit in the LGIP pool. And we have been also taking advantage of late last fall, First Interstate Bank offered an attractive rate on balances in excess of our $3 million PIK balance, which they were matching the current LGIP rate. And this has allowed the county to minimize transfers between the LGIP pool and the bank. So we've had more efficient funds management. And we've also, the bank benefited by us keeping a larger portion of our funding with the bank. So it was kind of a win-win. We were recently notified that they are reducing that rate down to 4.75%. And we expect further reductions in that rate over time. So they're also looking at this rate scenario and not paying as much for deposits as they were previously. So as a result, several weeks ago, we moved $20 million back to the LGIP fund to take advantage of that 5.15% rate that they're currently paying. So we're picking up that spread right now in the near term. So, Robert, anything else to comment on? In terms
I just
management?
had regarding that LGIP limit at 61 million, as Bill mentioned, is there's actually ORS allows counties 20 days. You're allowed to go over that limit because they recognize tax receipts come in, right? Millions of dollars. So it's a first in, first out. So we could technically at the end of November, we could be way over 60 million in the LGIP, but recognizing we have 20 days to hold it before we distribute it out. Cities have a $10 million, or sorry, a 10-day buffer that they can go over the limit as well. So they recognize you're getting lots of money in, and then you're distributing it out.
And they'll still pay their rates on it?
Yep. Yep. Still paying.
The increase in the limit, is that because the total portfolio is larger?
That's a state, oh, sorry.
No, go ahead.
It's a ORS, it's built in, there's an increase every single year. There's a formulary that they use, and so it increases every year. At the state level, that's the
So state
limit
says
for all accounts.
Yeah, they
that
set a
each
limit.
entity can put
Yeah.
in X amount.
Yeah.
Exactly.
And the limit for each entity varies.
Nope, it's the
No,
same
it's
maximum.
yeah,
for
Same 60
every-
million for everybody on your.
Yeah,
each
per
county or,
participant. So
or
some of the smaller
or you
counties,
can-
municipalities
exactly.
can take advantage
For
of
a
that.
small little school district.
So it's not
it's
the same
as fire district.
I'm surprised they do that.
Same limit.
Same amount,
Yeah.
Bill, on the treasury report dated September 23rd, the first bullet item says at the end of July was.
Yeah, that was a typo.
Okay, it should be on.
Yeah, I looked at that after the fact and I thought I cleaned it up from the prior month, but I had not. So yeah, I did note that when I went back and reviewed it. You're the only one that saw it before.
Hey, Bill, I got a quick question on the LGIP. How often does that interest rate reset? Does that just kind of depend on how they're looking at things, or is there kind of a frequency that's set for that?
Yeah, they actually take a look at the portfolio earnings is, I believe, how they reset the rate.
Okay.
So as rates continue to adjust, then they'll adjust that LGIP rate either up or down.
Okay.
And what we're benefiting by right now is obviously that's still very inverted yield curve. So the shorter end of the curve, we're still seeing some pretty decent returns. But I was surprised that they took as long as they did to adjust that rate downward. I've been expecting it for at least a month
So they,
before they actually adjusted that rate downward.
if things move quickly, they could also adjust quickly.
Oh, yeah,
or
they
they
can.
could be quite slow.
Yeah, there is no kind of preset. It's not like they adjust the rate, every 30 days or so. Yeah, they'll basically look at, portfolio yield and determine what rate they can pay out to the participants within that pool.
Probably approximate by just watching the rates staying.
We can see it.
Yeah.
Yeah, I think it was it was predicted. I was actually pleasantly surprised that they took as long as they did before they actually adjusted the rate down. But I think Robert and I were both kind of betting on when that was going to happen.
Yeah, I was surprised there was only 15 basis points when
Right.
the Fed did 50 basis.
Yeah.
Point adjustment.
But again,
So,
that's a function of the investment pool
yeah,
and
they
the
have
fact that they're
different
investing now.
durations and-
Yeah, they're not.
And so I was happy to see they weren't just like instantly 50, down.
Yeah. Yeah.
So it seems like they were trying to give us a down end, other end of the curve.
Yeah, so anyway, we're gonna take advantage of that rate for as long as we can. It's been a great buffer over the last 12 months, having that high yield and complete flexibility. So it's allowed us to be a little bit more judicious in terms of cash flow management, and also recognizing that as we invest out, and certainly as we head into our busy cash inflow period during tax collections, we don't need to be quite so aggressive to get those funds out, invested longer term. So, any other comments or questions on that? We've kind of dipped into this already, but I gave out 3 exhibits and wanted to talk about each of these just briefly. The first of which I've already touched on, and that's that 5-year maturity distribution schedule. And this was a comment and discussion that came out of our spring IAC meeting. We talked about trying to be a little bit more granular in terms of monthly redemptions and having clarity around the fact that we have dedicated redemptions that are targeted towards the pay applications that we fund on our monthly construction contract with Pence Construction on the courthouse. So what we've done is we've kind of match funded that. It's not exact. That project is a little bit behind schedule, so I think our cycle is going to be off just a little bit. But if anything, it's going to be, we'll have redemptions in earlier than we actually need to make the payments on the pay application contract. So, but anyway, that is something that we do present as part of the monthly treasurer's report, and this is also something that our commissioners pay close attention to as well.
Bill,
Go ahead, Brian.
do you expect to have to fill more in the 2026 period, or is that
We-
kind of pretty set and then you're looking out to 2027?
Great question. Just recently, in the last 30 days, I've started to fill in the buckets. I'm pushing that 3-year maturity schedule out, which is kind of where we've decided we need to be. There isn't enough, yield to pick up by going further out, and we're basically locking in funds that we can't access when we need to. So I'm still actively looking out at the back end of that curve and filling in some of the holes in between as well. Target is to have redemptions kind of in that $6 to $8 million
Yeah, that's what I'm
monthly range.
seeing as kind
Yeah.
of the median across the years there. And then 27, you're much lower. So that's where the gap is.
Yeah, no, great question. And again, that's what we're trying to do, is trying to fill out that maturity schedule to ensure that we've got scheduled redemptions come in on a monthly basis to buffer our monthly cash flow. The second comment or schedule I wanted to look at was a 3-year portfolio balance. And this is a perfect illustration of the seasonality of our cash flow. Obviously, you can look at the peaks over the last 3 years, which are targeted around our tax collections in November for the most part. And then there's been a couple of other kind of extraordinary events that ARPA funding, which occurred, I believe, Robert, that was back in mid-2021. I believe we got 2 tranches in, $18 million each. And that funding is just about fully distributed now. I don't think there's much left in the way of ARPA funding.
Could be about 4 million.
Okay. Compared to 36 million. So I'd say the majority of it is already allocated and fully dispersed. And then we had a small bond issuance associated with the Negus transfer station. And that was that 60 million? I don't recall the exact amount, but that was done, I think, before you and I both arrived.
I think it was near 20.
Okay.
Yeah.
And so that was an event, and that facility is complete now, so those funds are fully spent as well. And then we had the courthouse, the bond issuance, and also the funding that we received in from the Department of Justice. And those were received both in early 2024. And so when you start to look at some of those cycles and then build in some of the extraordinary events that are around that, makes sense. So when you look at the year-over-year increase in our portfolio, it's for the most part, it's primarily due to courthouse specific funding sources that we currently have invested and that they will be utilized over time to match the funding need with the courthouse.
The reserves that departments have,
Yeah,
they're in this balance, correct?
it's all on a consolidated basis. So both restricted and general funding.
Okay, because
So general fund is in there as well. It's on a consolidated basis across.
so it's, because I guess where I'm headed with my thought is some of this is allocated for specific contingencies or purposes or reserves. I'm going through the county college
There you go.
and.
So we'll see in a couple of weeks when you go through the finance.
Yeah, exactly. I mean, because as I understand, the fairgrounds has some maintenance reserve, repair and reserve or replacement.
Significant.
Yeah, and so that amount is in there.
I'm on the Fair and Expo board.
Okay.
Yeah.
And then the landfill, when it closes, it's got 10 million or something like that of that has to keep a reserve for contingency. So that is all part of this.
You're
200 million.
absolutely correct. It's on a consolidated basis.
So I guess where I'm headed with that thought is, so some of these are clearly long-term expenses. I mean, the landfill, is a 30-year commitment or something like that. So it's not an immediate cash flow need. So I guess my thought is a significant part of this is not the fluctuation of day-to-day operating income and expenses. It's reserves that are there for an extended period of time. And it varies, and that extended period of time will vary based on the type of reserve. So this brings the question, could the funds be invested longer?
You mean match funded basically to match that longer term need?
Yeah.
Yeah. Great question. I think a couple of thoughts. Again, we have an investment policy statement that limits our investments to 5 years.
Right.
So we have that out there. And then when you look at the yield associated with pushing those investments out beyond 3 years versus, risk and return there. And then, targeting or managing to that level of detail might be challenging as well, just on a monthly basis. I mean, it's a great thought. I'm just, from an execution standpoint, does that make sense? And I'll open it up to.
I was going to ask a similar question, because when I look at the 3-year chart, we don't dip below 225 million for 3 years. Am I reading that correct?
Overall, on a combined consolidated basis.
Yeah.
Yeah, you're absolutely right.
And I mean, that's where I would look at to say, hey, even if you're only getting 20 basis points to go from 3 to 5 year, if you're not coming close to dipping down, why not get that extra yield? I mean, I understand that you want some flexibility, but if there's a dollar amount that, like if you took 100 million and said, I don't know when the last time that balance got down to 100 million, but it's probably been decades ago. And being able to, squeeze that
Yeah, it would
extra.
be decades ago, but if, yeah, and I've got a much longer horizon. I might share that with the committee to show, I could show you what our portfolio balances have averaged over 10 years.
Because if you're at
And I could share that information, but
5 years and 2 years from now, something happens, okay, well, now it's only
Yeah.
a 3-year maturity. And, I mean, you can sell it, right? If you, something comes up that you need the funds. I know you got to issue a chain deed held to maturity versus
Yeah.
held for sale, but
Mhm.
And I think, kind of my view is, we've been in the past 4 years, 5 years, in a low interest rate environment, an extremely low interest rate environment. Now we're in a relatively higher interest rate environment. And, the risk is our interest rates going to go higher or they're going to go lower. And
Yeah.
while I don't think either one of those is very likely in a significant fashion, I think we're more in a more normal interest rate environment. And so if if there was value in matching the longer term liabilities with some longer term assets, would there be benefit to that?
And I think with, rate compression that's going on right now, there's a narrowing margin between treasuries, agencies, and munis. We're not seeing that 10 to 15 basis point spread out there right now that I had previously. And so there may be opportunities where there's a selective, maybe taking a look at a little longer term maturity, maybe out to 5 years. And saying if there's an opportunity, attractive investment that we feel comfortable, that we can push the money out on the back end of the yield curve and feel comfortable that we're not going to need it soon, I would certainly be willing to, consider that in the investing cycle.
I think, this chart, with the courthouse, helps clarify, the cash needs and the timing of those.
Oh, it absolutely, yeah.
And, obviously, getting down to the granular of the departments that have contingency funds, is too detailed. But the concept,
But the concept is, in general,
Yeah,
is
yeah, a really
something.
good point with the county runs pooled cash, and so it doesn't really matter if one fund is leaning too hard on another. Overall, you can take a big tranche at the bottom, like where it was being suggested, and then be able to take that, elongate that out.
yeah,
It's just the question, to me, always comes back, what was the duration gonna be? Pick it, stick with it, because we're gonna ride the wave up and down,
sure,
whatever we do.
right.
And,
I mean,
yeah,
rather than manage it all short term, and clearly, going beyond 5 years is probably not necessary to maximize your yield and still maintain liquidity.
Yeah, no, those are good thoughts. Yeah,
But
we haven't been, the return premium hasn't been there in this inverted yield curve that we've been dealing with for the last, 18 to 24 months. But I think if things normalize, and there's some experts in the room that are certainly more in tune with that than I am, but I think if we get back to a more normal yield curve where you get a premium for investing out longer than, that 24 to 36 month of the duration.
2 to 10 year went normal first of early September.
Oh, yeah.
Or 10 years,
Yeah.
2 year now. But the other, contingent risk, if rate, even if you go out longer for a lower yield, you've locked that.
But
in.
you've got rate certainty.
Yeah. And,
Yeah, I
and
agree.
that's, if you've got a predictable expense in these contingency funds, then the predictable income may be, better than the volatility, because
And Robert, if you want to maybe share some comments on our general fund and our focus on building some additional flexibility in our general fund, that might be appropriate if you wanted to maybe comment on that.
Are you referring to the emergency reserve?
Yeah.
Or, yeah.
Yeah.
One thing, the county hasn't had a general fund reserve specific. We've had contingency requirements like any other fund. So the general fund is required the contingency to have 4 months of operating tax. Whatever we expect to get in tax revenue in the next year, so a quarter of that, or 4 months of the 12, actually 33.3% of it, we're required to hold that in a contingency. because, as you know, tax revenue comes in November, so we need cash to be able to pay our bills from July, August, September, October until the money comes in. That's why there's that requirement. And that's the same with all of our tax supported funds. Other funds typically have an 8% contingency, but it can vary around there. Any excess revenue that we have in the general fund traditionally gets transferred out to the capital projects fund. And we use countywide for various priorities of the board. But we've never really established a general fund emergency reserve. And so that's something that the board has just approved this past year, was establishing an emergency reserve. And the idea is we need to hold, it's about $6 million in reserve for if there's some catastrophic event, perhaps there are wildfires, right, that we need to respond to. The challenge is if we only have our contingency and it's during that July through October timeframe where we're drawing down all that cash in the general fund, we need the emergency reserve to be able to respond to some major catastrophe like fire. So that's part of it. Or in case of economic downturn, then that emergency reserve can help subsidize some of the other core services the county provides until you get that revenue back. So we established a reserve, now we have to work on funding that reserve, and that's it. And as far as the other comment, as far as investing out further, it's a great goal as well. One thing, the first priority that we typically look at is, and it's back to the distribution schedule that you have here, is we want to make sure that we first fill in the cash flow needs at the basic level, whether it's the $6 million or $8 million per month. And then as some of those other higher months mature, then that gives us the flexibility to move it out further. So there is some, that comes into play too in some of that decision making, is making sure you fill your buckets or the ladder.
And that's the challenge that we face, is that we need to keep the kind of that stated redemption, targeted redemptions on a monthly basis, like Brian brought up earlier, before we have that flexibility to maybe consider investing longer term. But yeah, I look at those options. I receive quotes on a daily basis or offerings out there. And, as we see strategic investments that seem to fulfill that need, we have the financial flexibility to be able to do it. Would certainly look into that.
That would require board approval if you want outside the 5-year.
Yeah,
and it's on an individual basis when the board.
Yeah.
approves
Our
that.
current investment policy statement restricts us to 5 years.
Yeah, and I'm not suggesting to change that.
Okay,
at
yeah.
this point, I'm just
Yeah.
saying,
But looking at that 3 to 5 year window.
looking at that 3 to 5
Yeah.
year, and I think, academically, I think you can gain most of the yield by going beyond 7 years or beyond 5 years within that 5-year period. And reduce all the stuff. So even if you went out to 10 years, I don't think you'd pick up that much yield.
No.
So.
No, great discussion, though, and very timely as this market continues to evolve. We're not done with that, are we?
I don't think so.
Every day is a different day and a different set of economic circumstances. We'll talk about that here shortly. So, so I think I've covered the 3 exhibits that I handed out. Richard, you touched on the hold to maturity strategy that we have, so we're not incurring losses if we need to go back to individual departments and figure out what that allocation might be. We are just through maturities. We're working our way through a lot of those low yielding investments that we have out there. And I think we've done a good job over the last year of taking advantage of opportunities to reinvest proceeds to a much higher yield.
Do you want to speak to the milestone with Credit Suisse maturity?
Oh, yeah. Yeah, we had a little offshore investment in a little financial institution called Credit Suisse that was done. We were in this room, we were not involved in that discussion or decision, but it was challenging. Right after I assumed this position, there was a lot of question out there as to whether or not that bond would be paid in full. And it was actually, the bank was taken over by the Swiss government. They had a shotgun marriage and kind of stabilized operations. And And we actually, we were paid in full, here about 3 weeks ago.
Okay.
Yeah, so we got, and we were, in serious discussions with one of our brokers from Castle Oak regarding different options. They were, offering a discount for an early redemption, to any of the bondholders that wanted to take advantage of that. And it was about, if I recall, it was about a 30% haircut. And so we decided to stay the course. It happened quickly, evolved over a weekend where they were, close to going under on a Friday, and the Swiss government stepped in over the weekend, and they were kind of back again. But anyway, it was, just goes to show you, things can happen quickly. And so as a rule, I just generally, I like to keep our investments domestic.
And it was on a corporate bond on the US.
It was on the
Yeah,
US.
it wasn't like we were.
No, but it was-
Prior to us.
Yeah, but it was a Swiss bank.
Yeah.
Yeah, with Swiss operations and our global operations, I should say. And anyway,
Could have a layman.
Yeah.
Yeah.
They could have.
yeah,
When did that was a while ago that hit the news.
Lehman Brothers.
No, Credit Suisse.
Probably.
2 years ago.
That was March of 23. I should know that date exactly, like the middle of March. And it was like,
Shortly after you came.
oh, it was like 2 months after I stepped into this role, and I'm going, no, this is a kind of a weighty discussion. And then we'd have to go back and basically, if we'd have taken that discount and there were different tranches that they were offering it to. I think there were like 6 or 7 different tranches, but we would have had to gone back to the individual departments and reduce their percentage allocation.
Well, that was one of the things you shared previously was if you did mark to market, you have to go back to all these different departments and tell them, your budget's down this much or it's up this much.
Yeah, there's a lot of granularity that comes into play there that we just, and by a hold to maturity strategy, you invest and you hold the maturity with the rare exception, or again, back to kind of mid 2023, right before our fiscal year end, we liquidated a selective group, about $10 million in bonds that we discounted, and we took the proceeds because we needed to boost our short-term reserves. Very strategic, but we took $650, no, it was $350,000, $400,000 write down with that investment, is what I recall. But it was small enough that we were able to actually cover it with the monthly earnings in June. So we didn't need to go back to the various departments and make any adjustments there. But again, that's kind of the one and only time that we've done that.
And then reinvested at the
And
higher
reinvested
rate.
into much higher yielding investments at that time. So we were able to take advantage of rising rates and redeploying capital, but it's kind of a laborious process that we'd rather not do.
Yeah.
So a great discussion though. I really, really appreciate this committee's feedback. I will also mention too that for a period of maybe 90 days last fall, I was taking like a $5 million tranche and rolling it 30 days at a time into treasuries. But when short-term rates got to where they were, it didn't make any sense to do that any longer, because we could basically keep our funds in our pooled account or with the bank and generate a comparable return to what 30-day treasuries were paying. So I stopped doing that when it didn't make any economic sense. So I think we'll move on to the next agenda item.
What's this handout?
Oh, I'm sorry. I didn't actually talk about the third one. That's actually that simple trading document that I created.
Okay.
And that's an example of trades that actually I completed. That was October 3rd. And we basically had $4 million in excess funds that we had available, and went ahead and built out the curve. So you can see I invested in May, July, and August of 27, and ended up purchasing 2 U.S. Treasuries from one of our brokers and 2 agencies from 2 of our other brokers. And basically, it's just a comparison, not purely looking for kind of the best opportunity to fulfill or to meet those tranches. And not always an apples to apples comparison. Our brokers don't always offer the same investment with the same maturity. But basically, just how I basically support the decision I made, basically looking at what was my target, what was my focus, what were the offers that came in, and which seemed to best fit the county's investment need at that time. And again, these are very competitive, and if they are like-kind investments, I mean, some of these can be within a couple $100s of one another.
Sure.
I mean, it's just percentage point difference in the pricing.
And the yellow highlights are the ones.
Yeah, are the ones that I actually selected. Yeah. So,
So
but
if
again,
you're-
that, go ahead.
Under Davison, so you looked at, was it six bonds, is that right?
Yeah, these are basically just what they offer. So I send out a blind CC email in the morning to all of our investment brokers. None of them see what the others are offering, so it's fully independent. And then I just say, I've got a need. So basically, I'm describing my need. I said I've got $2 million that I want to place in 3 different maturity schedules. And what do you have available? And they'll offer up. We're getting a lot more munis now that are being quoted. But again, we're seeing a narrowing spread between treasuries, agencies, and munis, where we're starting to see that compression where there isn't, in my mind, there's a risk premium if you're investing in a treasury versus muni. So we've got to, be somewhat judicious there, but we also, and I'll give Robert credit for this, we like to scratch the back of other munis. So when there's opportunities, we had an opportunity a couple days ago with Lane School District, Bethel School District, and they had an investor that was selling a piece of a bond, and we had an opportunity to buy it, which we did. And so we're basically supporting the needs of other municipalities, because they did that to us when we issued our courthouse funding. So as these opportunities come up, we certainly, and the target is really Oregon and the Northwest. We're going to California maybe as needed, but we really like to stay regional in nature. And so I like that philosophy, and I think it's kind of reinvesting back into the communities that we all did business in.
Is there any preference from your guys' standpoint? Like if you're looking at a yield, whether you buy a discount or a premium bond? I mean, since
I
you're
think
holding
in a
maturity,
falling rate environment, when you think about especially anything that's callable, if you've got a low coupon, I do take that into consideration right now, where I'd much rather buy maybe a deeply discounted bond that has a low coupon, especially if it's callable, because there's not a very high likelihood of it being called. So I think that is a discussion that we're currently having right now. We have limits, we have portfolio limits on the amount of callable bonds that we can have in our portfolio, so we have to be mindful of that too.
well, and if you're buying at a premium, you're gonna start getting, if rates drop, you're gonna get premium compression too. So you're not gonna get as big of a bang on the market value.
But hold the maturity.
But if you're holding maturity.
We are holding the maturity. So I don't want to say that that's not material. In the event that we ever had to sell it early, we would certainly suffer the consequence there. But again, that hold the maturity strategy, that mark to market valuation is important in this portfolio.
It also depends, a discount is deferrable, especially it comes into play too on the accounting side when you're accruing all this. If it's called, because if it's a premium and it's callable, then that affects it as well, so.
Yeah,
But you're factoring that into yield to call.
Yeah.
we are.
yeah.
We are
It's
looking
in
at
there.
yield to call as well. And that's certainly something that I pay attention to.
And thank you all for the meeting.
Yeah, Robert, thanks for joining. Nick, do you need to step out as well?
I can probably wait, I'll probably just a couple more minutes.
Okay.
Okay.
Remember where I'm at here. I think we talked about holding maturity quite a bit. We've got our seasonal investment cycle. Obviously, we'll be coming into a large influx of tax receipts starting in late October, early November, and be going back into an active investment cycle, probably starting around the middle of November. What I do is I typically invest tranches. So we'll take a look at, we'll go into weekly turnover, where we turn over tax receipts to all the special districts and municipalities, et cetera, where City of Redmond will also get a large influx of tax receipts from us. But we basically look at what's available there, and then I'll start doing investing at that time. And that investment cycle will take place through the end of the year and probably into January, February. So. I think we are actually to the point where we can talk about market for a minute. This is the part that I really enjoy, talking about market discussion. There's absolutely nothing going on out there right now that might cause any kind of market disruption. And I'll just maybe go around the room and open it up to general comments. James, do you want to go ahead and lead us off?
Yeah, I'm curious. I've been watching the federal treasury yields lately to see what they were doing after the Fed took the 50 basis point reduction. Like I mentioned earlier, LGIP went down 15 basis points. So that was kind of surprising, which I'm looking at it from my perspective of trying to definitely not time things, but just curious of how fast LGIP can respond to it. So I thought that was pretty an interesting indicator that they didn't go down as far as what the Fed did. As far as future cuts, I think this election is going to really, it can change things one way or another. But right now, I think I just anticipate that they're going to continue with the monetary easing and lower the rates over time, at least the target. So that's what I'm anticipating. So go back to the hold maturity, set a duration, live with it, and strategy. So
There's 2 Fed meetings between now and the end of the year, so November and December meeting. Yeah, so we'll have to wait and see what happens there.
things look big would have to happen for them to reverse course or even just flatten out with it after. Yeah, it took so long to get to the point where they turned the other ship around. The other way.
Yeah. Craig, any comments on your end?
Well, I think, I agree with James. I think rates will continue down slowly. I don't, Fed may cut rates, but you're looking at the chart, Fed cut rates and the 2-year and 10-year rates went up. Yeah. So I think, the market anticipated the rate cut, and then what happened, it was kind of one of those, buy the rumor and sell the reality. And I would kind of expect that to continue. I think, we clearly have a strong economy. Jobs report came out last week. That was strong.
Yeah.
Inflation is lower. I think inflation is still going to be kind of sticky, especially in consumers' minds. It's going to be sticky because they're looking back to what prices were 2 or 3 years ago compared to now and saying they're up 20%. Factor fiction. I don't know who you talk to, but they're not looking at, they're the same or a little bit less than they were a year ago for most things. So, and we've got some budget deficits coming regardless of the election. Both of them are proposing for pretty significant budget deficits over the next several years. That is going to strain the bond market. So I think a likelihood of a rate cut going back to where we were, I think is low.
Zeros.
Yeah. So I think, we're going to stay in this, I want to say 5% range, 3 to 5%, 3 to 6% range, for a little while longer, if not an extended period of time longer, barring any, significant geopolitical or economic events. It'll be interesting to see what happens with construction commodity prices after these 2 hurricanes.
That's what I've been thinking about a lot. Talk about an inflationary event.
Yeah.
That's absolutely what's going to happen there.
So, that's clearly a price pressure on inflation. We're seeing the unions, win some concessions in additional labor. you know, that's inflationary at some point. So, you know, are we going back to the 9-10% inflation? I don't think so. I don't think there's anything that significant out there, but we still got this grinding high deficits, rising wages, you know, some commodity prices are higher, you know, that's not a deflationary environment. You got China that's been in a deflationary period for several quarters. They're trying to reinflate their economy. You know, I think economists would generally prefer inflation over deflation. So, you know, politically, that's a little more difficult to sell inflation, but that's economic. And a way to get out of the deficit situation is inflation. Or one way to get out of it is inflation, because now you're paying back with cheaper dollars. So I think we're in a trading range, you know, of what somewhat narrower like we've been the last couple of years, but without any significant deviations from it.
Yeah.
I mean, clearly the Fed's I think, gonna lower interest rates slowly, but I think it's gonna be slow.
Yeah, no, thanks for those comments. You know, in general, I mean, what I'm seeing out there, again, is probably somewhere between 25 and 50 basis points of rate cuts between now and the end of the year. I think it might be 2 25 basis point cuts, maybe one in November, one in December. I think the Fed is going to be cautious to not make it appear to be too politically oriented. I think that's going to come into play as well. I'm a little concerned about our inability to lead in terms of adopting a budget, a full-year budget. So we've had 7 continuing resolutions. The last was the one that pushes our short-term funding limits out to December 20th, I believe. And so they're going to try to have our current Congress act before our new Congress steps into office in January. Around the holidays, that is just a recipe for disaster. But that was the only thing we could do to basically continue to fund our government for 90 days. And so that's a big concern for me. Just ongoing funding and having, you know, kind of political will and courage to, you know, make the tough decisions and come together and agree on a funding package. So we just continue to kick the can down the road and it's not accomplishing anything at all. I too am concerned about inflation, and I think that jobs report last week caught everybody off guard. Now, a lot of these jobs reports, the next month, they tend to adjust downward. So there may be some downward revision that happens there, but you know, the inflation animal is not dead yet. And I think it's going to be challenging to get down to that terminal 2% rate that the Fed would like to see. And you know, the dock worker strike that was averted temporarily for another 30 or 45 days or whatever. And they walked out for a day and a half or 2 days last week, but that could have a huge impact on our
And
economy.
what did they want? 60 or 65% wage increase?
Yeah. I look at what Boeing's striking workers are asking for, and that's what, a 40% increase in wages over 3 years.
I don't think the Fed's gonna hit that 2% inflation target.
I don't think so either, but Richard, any comments on your?
That, I don't think.
Oh, yeah. Yeah, thanks, Nick. Really appreciate your participation.
I don't think we're gonna see rates anymore. I mean, that's probably once in a lifetime, maybe twice in a lifetime, where you have 30-year mortgages below 3%. I mean, I remember when I was first got into finance, and one of the companies I worked for, it was a home builder, and they did loans, and they held some of the loans. It was one of the top 10 home builders in the US, and they had some loans on their books, mortgages that were like at 6%. And that was when mortgage rates were 12.5. And I thought, oh my God, it'd be so great to have a 6% mortgage. And then it hits, you know, 2.5.
Yeah,
But
that's the new oil.
But I don't think that, you know, the Fed's gonna get inflation to the 2%. I mean, that was just an arbitrary number that a lot of the G7 companies threw out there, or countries threw out there.
And is that a real number anymore? I mean, is it a sustainable number?
I don't think so.
Yeah.
You know, I mean, not when you look at all the, you know, all the labor costs that are going up and everything else that's hitting it. I don't see it. I mean, the Fed will cut, but I don't think long-term rates are gonna drop dramatically. And that's just my
Yeah.
opinion. There's too much pressure, and the US government's got to get their budget under control. That's the biggest issue. Because that's what's driving inflation. It's not, you know,
Yeah.
shortages of supplies. or whatever.
Deficit spending and.
Yeah.
Brian?
I think, I'm on more of a hawkish tone than the other's tone. I don't know if I fully agree with the cuts to the extent that they're being called for. You know, we're not at the target rate yet. We still are seeing quite a bit of inflation. And as we all know, inflation is sticky. That's what you learn in economics 101. And it tends to stay around for longer than you think. Everything that I've seen shows the economy is still doing pretty good. Consumers holding in.
Mhm.
I think what you run into a problem with is, I think of housing first and foremost. You start to drop rates too much. There's so much pent up demand in certain areas and money that's kind of sidelined that you risk inflating it again if you go too quickly the other way. You know, there's definitely a point with mortgage rates where if you get to that, it's going to be gangbusters again, and then you're right back in the cycle, and then you can't reverse yourself. So I'm a little bit more concerned about that, of what happens if things do fully stabilize and get better than expected. Are they going to be able to reverse course to be able to tame that down again, versus letting it run maybe a little bit higher than they wanted with rates, just to push that down before they start to cut?
In your mind, then that 50 basis point cut was a little too aggressive
Yeah,
early on?
Yep.
Yeah.
I think they got pressured by too many people calling for it. And I'm not on that same page necessarily. I agree.
Yeah, I think I do as well. I think the market anticipated it. I think part of that was in response to not making cuts sooner. So I think they were thinking, well, wait a minute, we need to play catch up here a little bit, but I thought that sent the wrong message to the market. But it's
now
hard to
they're
fine
trapped.
tune things.
They're trapped now. They set the motion downward.
Mhm.
They can't go back up.
Yeah.
They've
I mean,
tried.
I'd like to see him pause the next 2 meetings.
Oh, I would love that.
That would be an interesting message to send.
Because that's, I mean, well, it's not the same as raising rates,
Yeah.
but it's
Mhm.
getting people to realize, okay, we're not going to go back to, you know, 50 basis point Fed fund rate.
Mhm. Yeah, slow and cautious.
Although, I mean, what did China made a big cut? I don't know how much it was, but because they're really trying to stimulate. I mean, they got a huge housing problem, huge real estate problem.
Yes, they do. Yeah, overinflated and under supported. A lot of irrational exuberance going on in
Yeah.
real estate development in China.
Oh, yeah, the full on ghost towns.
Yeah, high rises that are completely vacant.
Yeah, they're vacant, but you got people that buy the things because that's where people are parking their money. And that's why you've had a lot of overseas investors come over here to buy up housing and other things. They just don't know where to put their money.
No, great comments. Really appreciate that. I look forward to this every time we get together. I would say we're getting down to the end of our discussion. Just a couple comments. So our investment policy statement, we review it annually. So we reviewed it during our spring IAC meeting. I think the only change that we made there was just not me sending out the monthly treasurer's reports. Those are being posted on our public site. Occasionally I'll miss it by a couple of weeks after. I don't post until actually I've presented to our board of county commissioners. So that's sometimes the timing may not be quite exact there, but I think, is that working out well for you guys if you want to tap in and look at? Okay, that's a huge help for me as well, not to be responsible for sending those out every month. And then also wanted to comment on the fact that I went through my annual review of our existing broker dealers as discussed in April and completed that
Down to
review.
5 on the
What's
book.
that?
We're down to 5 on the book. I like it.
You're reading ahead. So we started out, we had 7 broker dealers and we're down to 5 now. And I think that's a good number. There's a few times where I'll reach out to our brokers and for whatever reason, they might be on vacation or they're not responsive or whatever, but I'm typically getting at least 3 to 4 quotes on every bid. And I need to have 3 if I can. If it's a like kind investment, I need to have 3 quotes there. So I completed that review down to 5 brokers. And what I did was I personally contacted 2 existing brokers and that we did not review to basically communicate my decision and the rationale behind that. And there was a thought process that went into that. So I was able to, basically look back over the almost 2 years that I've been in this role now and basically look at, who's providing timely, responsive quotes and how competitive those quotes are as well.
On your sheet here, so you went out and you said, here's what I'm kind of looking for. And then these are the bonds that they presented, correct?
Yes.
Then if you looked at, say, Great Pacific had the $1 million Freddie Mac, did you then go to the other brokers and say, what can you get this for?
I can't do that. It would just be way too much back and forth.
Okay.
If they don't, if it's a one-off, I'll go back and I'll actually look at the market and see kind of what's going on there. But I've got to be careful that I don't just keep rebidding it or let it stop.
Right.
Yeah, because these things, as you well know, you've got to be responsive within about a half an hour to 45 minutes after you get the quotes or the market's moved. And then you're trying to play catch up. So you have to be, basically the way it works is give me your best bids first, and then I can compare and contrast and look at what's available and then make decisions on that. If I've got 2 brokers that are really close and the market's moved, I'll go back and have them rebid it, but don't open it up to all
Okay.
responses.
So you're not looking and going, okay, we need to fill August 28 bond and then going to them and saying, what do you have?
I am offering initially when I send out my email blast, I'll say I've got 4 or 5 tranches that I need to fill, dates, and let me know what you have available. And if it's specifically, treasuries or agencies, I'll state that. But recently I'm being much more open about just because of what that, compressed yields. I want to look to a broader array of investments that still meet our investment policy statement requirements, but looking at some corporates as well as and munis as well, like I mentioned. Yeah, but again, trying to make sure that the county's getting a fair deal, the best deal that we can, but you've got to be careful that if you just kind of keep rebidding and going back.
I just didn't know
Yeah.
Because when I was CFO at a savings loan, I was more looking at specific issues. And so then I'd say, hey, I'm looking at, the Fannie Mae non-callable.
I'm not, I'm trying not to be that granular because frankly, I'd like to see what's available out there. And they know, they have copies of our investment policy statement. They know exactly what our investment parameters are. And they're really good about that. Very rare occasion will I say, that particular investment is not advisable under our investment policy statement. But for the most part, they tend to self-police that when they provide their offerings.
The county doesn't get any tax benefit per se of municipals, do they?
No.
So I would think that you're rarely that's gonna be an attractive option, right?
Yeah.
I mean, because for
Other than, like I talked early on,
Yeah.
around investing in local agencies that, we feel compelled. There should be a yield premium there, especially on some of these lower rated. They're an Oregon issuance, single A by all 3 rating agencies, falls into our investment policy statement, but we should get a risk premium for that as well.
Yeah.
Because it's not comparable to a US Treasury bank.
No, and that, I mean, for people in a high tax bracket, it makes sense.
Yeah, it might in that regard. But again, that is not a large percentage of our investment portfolio. But it's something that I believe that we need to consider on occasion. So not a target, but just as the opportunities come up. So,
I got a quick question. Do these, the quotes that you got back and the offerings that they have, does that kind of line up with how you see the different brokers in terms of specialty?
I do.
Like Castle Oak, it's all treasuries, Great Pacific is no treasuries, corporates, munis.
You know, on occasion, it's that way, but not always. And I think that particular email communication that I sent out, I kind of opened it up across the board. And I said, hey, as you know, rates are compressing here, let's take a look at a broad array of qualified investment opportunities. And so I think that's what happened there, was they didn't all respond in like fashion, which actually I kind of appreciate that.
Yeah.
Because I've had some quotes where I've sent out a request and they all come back with the same 5 treasuries or whatever. And then it's a simple matter of looking at, you know, $100, $200 differences on a $2 million purchase that,
Right, they all should be able to quote you a treasury.
yeah, they all should.
The
And they
difference is
can't.
gonna be what they have, maybe an inventory for corporates and stuff.
That's where I'm seeing the differences, and that's why I'm trying to open it up. If they've got something that they're holding in inventory that they bought right, and it's an opportunity for the county to make a good investment that,
Would
They
it
might
need-
wanna get rid of it.
yeah, they do, and they're trying to move inventory as well.
Would any of the bigger, like Morgan Stanley, Goldman, you know, would they have because they're probably carrying a larger inventory. I don't know if that would make
Yeah,
sense or.
this is, and you'll notice that, with the exception of, you know, Piper Sandler, you know, obviously a much larger firm. We do have some boutique firms that I appreciate their flexibility. And I'll say one thing, Castle Oak and Great Pacific are very competitive on their pricing. Typically, they lead the larger firms because they don't have as much overhead. Oh, yeah, they're lean and mean, and so I appreciate that. And I also appreciate the responsiveness. And we've had some of those firms where we've had a 20-year relationship with them.
Right.
So, and I value that.
Yeah.
So they know what we need, and boy, they are very responsive.
Well, you're not getting them trying to sell you junk.
Yeah. Yeah, they're not pitching deals just because that's the flavor of the month. And so yeah, Brian, you've been involved in that, haven't you?
Yeah, yeah. Goldman will treat you like, you know, gum on the street.
Yeah.
Yeah.
You're not big enough to
No,
order to bump in the
you're
road.
not moving those.
Did that
I just
answer?
Why
that
did
answer
you
your
know if
question?
someone like Goldman had a bigger inventory to where you might see some better
Uh,
stuff, but then also, like you said, they don't care
Yeah.
about.
They are very much relationship oriented. They attend our annual OACBO conferences, and they really do, I think, appreciate the relationship aspect of what we do. Have an
It makes
opportunity.
sense that they're smaller, they don't have the overhead, so they can run a dinner.
Yeah, they're nimble, and I would say of those that are, you know, our 5 brokers, there's a couple in particular that are very competitive. And they're typically the smaller kind of boutique houses that,
I would say that in my experience, the stronger relationships with brokers matter more than necessarily some of their capabilities, because they're gonna be the ones that can come in and help you in those times you need help.
Yeah.
And
Yeah.
that's what you really want. On a quantitative basis, most of these guys can quote the same thing.
Yeah.
It's that qualitative aspect that's missing at times.
yeah, no, great comments. And I will share that Castle Oak was, so the Credit Suisse investment that we talked about earlier, we were working very closely with them, and we were considering whether or not to take that discount and get out of that bond. Very responsive, and they were providing good advice on, you know, they were basically saying there's significant talks going on right now with the Swiss government.
Yeah, you might not get that like glove treatment. with
Yeah.
Yeah.
larger firms.
Yeah, so I'm very appreciative of that. Any other discussion items? We're just
Do
about
they
to end.
ever offer you a slightly higher yield if you went 2 million instead of 1 million?
No, the pricing does not, from my estimation, the pricing is not dependent upon the size, but it's dependent upon the type of investment. Anywhere from, because I've actually gone back and I've said, well, instead of 2 million, can I do 1 million? And it's the same price.
Same brand, okay.
Yeah, so it's not a volume based, you know, if you do 2, I'll give you a little bit more aggressive pricing than
Okay.
for 1 million.
I mean, you might see, you know, a plus
Yeah,
if you go up to 20 million or
Yeah.
something like that.
Yeah.
That's not, I mean, I haven't traded bonds in a long time, but that's what I noticed was
Yeah.
very small.
Yeah, but in the range, I'm typically, a lot of my investments are in that $1 to $2 million range, where I'm trying to get some economies of scale.
Yeah,
Where if I've got to deploy $50 million, I can't do it at 500,000 a whack.
yeah, you don't want to do that.
Um,
But on the flip side, if you're saying I want 10,000
Yeah.
of a face size bond, you're
Yeah.
gonna get hit.
Yeah, no, rarely am I dipping below 500,000. I'm just trying to be efficient with our investment activities.
Yeah, well, with $250 million.
Yeah.
You don't want.
I've got to remain cognizant.
Yeah, you don't want 1,000 trades.
And that's why they return my calls when I. Yeah, any other comments?
I like to see 5.
Okay, good. No, I really, if not, I'll entertain a motion to adjourn. Anybody?
Or I guess I'll make the motion.
Second.
There we go. Okay,
Nice.
we stand adjourned. I do want to thank each and every one of you. I really enjoyed getting together with you and appreciate your insight and guidance and observations. I know it's taking time out of your busy schedules, but except for Craig, I think you have some extra time right now.
Yeah, I got a little extra time.